Right, well, welcome everybody. I'm really pleased that we've had such a good response to this, this webinar that we're holding on financial stress in growth areas. And it's particularly timely that we're talking about this today when, we know so much more about what's happening with JobKeeper and JobSeeker, and there's some new data that's come out that we'll hear about as well. So I think this is really the start of a really challenging and significant period of time for growth area communities, and I'm really pleased that we can talk about it today. I'd like to acknowledge that I'm coming to you today from the lands of the Boonwurrung people of the Kulin Nation, the traditional owners of this land, and I'd like to pay my respects to their elders past and present. We do have people on the line today from across 4 states, and just about all of our 20 member councils are represented. And the thing that is, I suppose, quite daunting, but might feel even more daunting after we've heard all of the conversation today, is that all 20 of those councils, large, growing councils, are all facing the very same challenges that we're facing today, that we'll explore today. So we first had the idea for this webinar on mortgage stress and rental stress and overall financial stress back in April, when here at NGAA we were putting together a paper to submit to the federal government about economic recovery from the pandemic and the role that growth area councils can play in that. We found during our research that 16 of the top 20 postcodes for mortgage stress, this was back in April, were in our member councils. And so since then, of course, the pandemic has continued, the national economic situation has worsened, and today, we know more about our economic situation. We know that business is still a long, long way from returning to anything like pre-pandemic levels. And, just today, the federal parliament has agreed to reduce JobKeeper payments. What all this means for households in growth area communities is what we'll talk about today. And we're going to hear from 3 great speakers to help us unpack this issue. So first I'd like to introduce, I'll introduce each of our speakers and then we'll hand over to our first presenter. So Martin North, who's the principal at Digital Finance Analytics, and I have to say one of the most prolific bloggers, podcasters and media commentators in the Australian financial sector. I'd really encourage everyone to have a look at digitalfinanceanalytics.com once we finish this webinar. It's an incredible resource, so please visit. Our second speaker today will be Matthew Martin, who is the Program Manager of Financial Services in the Economic Vulnerability Program at West Justice. And West Justice is a community organisation that provides free legal help to people in the western suburbs of Melbourne. And our last speaker today will be Kelly Grigsby, who's the Chief Executive Officer of Wyndham City Council in Melbourne's West, home to over 270,000 people and amongst one of the fastest growing councils in Australia. Last year, its population growth rate was nearly 6%. That's 2.5 times the national average. A little bit of housekeeping. If you can all keep your microphones muted, please, unless you're speaking. We will have a Q&A session, hopefully starting about halfway through this hour. And if you'd like to put your questions in the Q&A box at the bottom of your screen, that would be great. And I'll then sort of group questions together and moderate that and ask the questions at the end of the session. We are recording this webinar and we will make it and some other resources available on the event page on our website. So keep an eye out for that. So without further ado, I'd like to hand over to Martin North.
Great, thank you very much, and hello to everybody, and thank you for giving me the opportunity to share my thoughts with you. What I've called this is household and financial stress in 10 minutes, and that's a tall challenge, but we're up for it. So what I'm going to do is just quickly go through some key slides about the financial stress, specifically focusing on mortgage stress, and explaining a little bit about where we get our data from, what it's telling us, and then drill down into some relevant postcodes, because the center of gravity with regard to what's happening is right in those high growth areas. and perhaps we can explore some of the reasons why that's the case. So just to take the conversation forward, the first point to make really is that I do a lot of research. We survey households all the time, 52,000 in the sample at any one time. This is primary data. It's right up to the end of August, so it's bang up to date. And one of the critical things we look at is mortgage and financial stress, rental stress, and also even stress amongst property investors as well. It's part of a big research program. If you go to DFA, you can get a lot more about that. But one of the things that's critically important to understand is that mortgage stress is a critical driver of what's happening at the moment for many households. And it's having a direct impact also in house price growth as well. And when we take that and look at house price trajectory in the past, buying and selling intentions and migration statistics and other economic data, we can bang all that into our core market model, and then we can make some predictions about what's happening with regard to home prices. So there is a very strong correlation, not only on cash flow terms for households, but also psychologically and importantly financially, what's happening to house prices ahead. In other words, mortgage stress and house prices are fundamentally linked. And just to show you that, we're going to now look at mortgage stress. So this is measuring cash flow in, money out for households who are borrowing. And essentially, there are about 3-point-something million households who have a mortgage. And at the moment, 40.1% of those households are in mortgage stress. And you can see the yellow line here, which is showing the significant travel over recent times, but a significant jump from February, where it was 32.9%, to 40.1% in August. I'd also make the point that the household debt ratio has been rising steadily as well. Those two things, of course, are related. And my estimation is that because of the cliff, the fiscal cliff ahead, we're going to see that rising even more in September. Now, I can share with you some top-level data. So 40.1% of households, that's 1.5 million households in stress across the country. In percentage terms, by state, Tasmania, then Victoria, then Western Australia lead the way. But in fact, the number, the biggest number is in Victoria. That's of course related to the lockdown, then New South Wales, then Queensland. And if you look at it by segment, so this is another way of looking at the same data by the profile of individual households, young growing families and those on the urban fringe, both battling urban and disadvantaged fringe areas, are extremely highly represented in the surveys. 73% of young growing families, including many first-time buyers, then battling urban and disadvantaged fringe. Note also that exclusive professionals, the top end of the sort of the value chain in terms of income, are also quite well represented in terms of mortgage stress. So this is something which isn't just touching a few segments, it's lots of segments. First-time buyers particularly being hit badly. And I can drill down to individual postcodes. So here's just a few examples. The most stressed postcode at the moment is Ballarat 3350. And then we can look at 6030 and 3029. You can see there 7,000, 6,000, 6,000, 5,000. These are the number of households in those postcodes who are experiencing financial flow issues at the moment with a mortgage. And that, of course, leads to pain later. And we can also look at it by rental stress, just to give you a complete picture. There, 41% of those in rental stress, that's 1.7 million, came out in the survey, 53% in Tasmania, 43% in Victoria, again, related to the lockdown, but significant across the country. And by segment, the same story, young growing families, battling urban, disadvantaged fringe, 74% of renters who are young growing families have financial flow pressures. That's a very significant and a very troubling number. And unfortunately, we've seen that growing just like mortgage stress. And interestingly, the distribution of postcodes is a bit different. So Jarvis Bay actually has the largest distribution of rental stress at the moment. But then we've found places like Campbelltown and Liverpool and Gosford and Mount Druitt and Greystanes and places like that in New South Wales, and then down to Victoria, like Hoppers Crossing again, 3029. So you'll see these same postcodes coming up again and again. Wollongong is another example, and then Bundaberg up in Queensland. So pretty much wherever you look, rental stress is a problem. And then the third dimension is property investor stress. So why am I talking about that? Because many people who are property investors are potentially going to have to make hard decisions themselves as well. So in fact, we find that 33% of property investors in New South Wales are stressed, and 33.1% in the ACT and Victoria not far behind. And overall, 25% of property investors, or 826,000, are actually now in cash flow issues with their investment property. So unfortunately, whether you're an owner-occupied or a renter or a property investor, things are not looking good. Now, to really make it come a bit more powerful, you can look at it by segment again, but here, young affluents and exclusive professionals. So the more wealthy people here are actually more exposed to investor stress. And in terms of postcode, Melbourne 3000 is the most highly stressed investor stress postcode, followed by St Kilda, but then Mandurah over in the west and Meadow Springs 6210. I watch Mandurah very closely. That's a bellwether postcode in my view. Stress was building very high over the last 4 or 5 years, and we've now got to the point where home prices have dropped 38% from their peak. And in addition to that, the number of people who are struggling and property investors who are struggling have gone through the roof. And we also see a lot of social issues coming out the back. And the point here is this isn't just a financial discussion. This is a social consequence discussion. And unfortunately, a lot of people, I think, are going to get bruised along the way. Now, if I then drill into the postcodes that you asked me specifically to look at, the first one is 2170, which includes Liverpool. And there we've got 35,000 households, of which 56% of those borrowing are in mortgage stress. 56 is very high as a percentage, higher than the national average of 40. And we've also got 54% of people renting there. So we're seeing considerable pressure in that area. One reason why we're estimating home prices will slide in that particular postcode. And these numbers have been rising quite fast. Another New South Wales postcode is 2567, and that includes Mount Annan and Narran Vale, those places. And there we have 12,000 households in the postcode. 64% of those borrowing are in mortgage stress, and 70% of those living in the area are in rental stress. Extremely worrying numbers there, some of the highest that I see. And again, we are seeing prices falling as a result. So there's a strong correlation between these stress numbers and what's happening to house prices. In Western Australia, 6060 is one I was asked to look at. There, again, 12,000 households, 64% of those in mortgage stress. A smaller number in rental stress, only 35, but the 64% is a very significant number. And prices, of course, have fallen in Western Australia for quite a long time, number of years, but they're still predicted to fall based on our modelling. And we can look across the Victoria, 3806, and that includes Huckaway and Berwick. And there we've got 17,000, one of the high growth areas, of course. 90% of homeowners in that postcode, 90% are in mortgage stress, and 60% of those renting are in difficulty. 3029 is another one with Hoppers Crossing and around surrounding areas, another 30,000 households there, of which 66% are actually in mortgage, in rental stress. Mortgage stress is not too bad, but if you look at it in number terms, it's more than 6,000 households out of 30,000 that are actually in difficulty. So it's still a very significant issue. But this rental stress number in this postcode is, again, very concerning. And once again, we see prices beginning to slide as a result of that ahead. And finally, 3030, which is Point Cook and Werribee, those areas, 36,000 households in and around that area, of which 7,800 are in mortgage stress. That's 40%, so that's a national average number, but it's a large number of individual households. And we also have 5,400 households in rental stress at 37%. So my point is that if you just look at it in percentage terms, it may not tell you the full story, particularly if you have large number of people in the population in the area. So the numbers are important as well as the percentages. And my final slide is this. This is actually a view of Melbourne. And what I've done here is essentially, essentially just mapped the distribution of mortgage stress. And the point I want to make is there are hotspots. The area over here, which is to the east of Melbourne, beyond the Dandenongs, is a very significant area around South Yarra, around there, and up towards the north and the northwest. Pretty much wherever you look, you can see the hotspots. And this is a very powerful way of making frankly, a very obvious and very critically important point, that mortgage stress is not uniformly spread across geographies. But there is a very high correlation between mortgage stress within a particular postcode and what's gone on there in terms of high volumes of construction, high volumes of growth, high volumes of migration. And quite often in these high growth areas, what we see is a lot of people who are actually up to their eyes in mortgage debt, plus multiple other forms of debt, are struggling with very limited resources to try and manage their way out of it. And unfortunately, they get themselves deeper and deeper into difficulty because they reach for credit card debts or even buy now, pay later debts to try and solve the problem. There is a structural problem in many of these high growth corridors. And unfortunately, because I believe that we're only in the foothills of what's happening with regard to mortgage stress and indeed home price falls, my belief is that this is a crisis that isn't just going to be a few weeks or a few months old, but this is going to be several years. Certainly the experience from both the UK and the US post the global financial crisis was the peak problem hit in year 3 and year 4. And I think we should be planning, therefore, for the long term and not just the short term. So I hope that's given you a quick overview. I've rushed my fences a bit just to get within the time frame, but I hope that has nevertheless been a useful conversation. I'll hand it back.
Yeah. Thank you very much, Martin, and such useful evidence to sort of get us thinking about what lies ahead, and also just to think about the scale of what's happening in growth area councils. You know, it's as you said, sometimes the percentage looks like the average, but the actual number of households is enormous. So thank you very much. We'll come back to some questions during the Q&A session, but now to sort of move on to what it means for people on the ground and in the community, I'll hand over to Matthew Martin from West Justice.
Thanks, Bronwyn. And please let me know if the audio is not picking me up along the way. Thank you. So thanks for having me. My name is Matthew, and yes, I work at West Justice Community Legal Centre. We service the entire western suburbs of Melbourne, and I'm here to talk today about our mortgage wellbeing service that we run. The service is it's essentially 3 services in one. It's providing a lawyer, a financial counsellor, and a social worker working together to address mortgage stress and clients who are suffering from mortgage stress. And it's important to note that mortgage stress is not necessarily just being in default on your mortgage repayments. It can also be being in default on credit card repayments or some other debt that can impact upon your mortgage. Council rates is another good example of something that if a customer is in default on, can directly impact on their mortgage and lead to repossession of their home or falling into the homelessness sector. So the aim of the mortgage wellbeing service is around early intervention, to get in early, to put safeguards in place, and to provide services to stop clients from entering into homelessness. And we do that by providing the 3 services in one. So we have the lawyer handling all of the legal component of things, making sure that repossessions don't happen, liaising with the banks in regard to any legal issues, might be irresponsible lending or any other legal issues that are occurring in relation to the mortgage. Then we have a financial counsellor who works on an ongoing basis with our clients to address their financial issues and try to put in place a system or sort of a budget to work with the clients and try to ensure that they can stabilize their situation. And then we have our social worker, which is arguably probably the most important component of the program. And that's trying to ensure that all of the clients' social and health issues are addressed. So that might be referring our clients to family violence support services, mental health services, food banks, any sort of support they need to try and stabilize their life. And that leads me to talk about the impacts on mortgage stress. And what we see regularly in our casework is things like family violence and mental health, which are factors that are regularly talked about at the moment. And they are what we see. I think it's about from memory, it's about 30% of our clients have reported as having a mental health issue, and 1/3 of our clients being directly impacted by family violence in impacting on their mortgage stress. So these numbers are very high, and they are a regular concern for us at the Mortgage Wellbeing Service. And now, as we all know, a new concern which directly impacts on these things is COVID-19. And we've seen that COVID-19, especially in Victoria and in the western suburbs, with people having to be locked down in their homes, that can directly impact on people's mental health. It can lead to increased instances of family violence, with people having to, or at least victim survivors of family violence maybe mistakenly thinking that they have to remain in their home if they're in a violent situation, which puts their health and safety at risk. So COVID-19 is something that we are now, is now at the forefront of our concern at the Mortgage Wellbeing Service. And it's very interesting that Martin mentioned a lot in his presentation about the suburbs, the postcodes 3029 and 3030, which is Hoppers Crossing and Werribee, being very high in the mortgage stress statistics. Because what I noticed recently, I looked at it within the last month, and the numbers of COVID-19 infection, the postcodes of 3029 and 303 were in the top 3 within the last month of COVID-19 infection. So that directly correlates with the mortgage stress numbers. So we are seeing that is impacting directly on mortgage stress, and it's finding its way into our casework. So we are seeing in our cases where direct instances of people losing their employment due to COVID-19, and then also not being able to sustain or find another form of employment after losing that previous employment because of COVID-19. It makes it harder for people to find new employment. So COVID-19 is affecting all of the typical factors that impact upon mortgage stress and only further exacerbating them. That is what we're seeing in our casework. And the most, I guess, concerning thing is that at the moment, the banks are allowing moratoriums on payments, on mortgage repayments for customers who are directly impacted by COVID-19 or who report that they are affected by COVID-19. That's all well and good at the moment. In the short term, that is beneficial to customers of mortgages, but it is the avalanche that we are preparing for, which is what we're concerned about. And that is the point in time where the bank's assistance in regard to mortgages ends, where they stop putting moratoriums on payments because there cannot be moratoriums forever. And what people might not know is a moratorium does not mean that you do not have to pay that money back to the bank. It does not mean that it is a freeze on payments and that money is not owed to the bank. That money that you don't pay, if your payments are put on hold, forms part of your arrears balance. So you fall behind on your mortgage payments by the amount that you don't make, even if a moratorium is granted. So it is that factor that is most concerning. When the moratorium assistance ends, there is going to be a plethora of customers who are in arrears and are in mortgage stress and might not necessarily have a way to pay that back. And we're doing a bit of work at the moment, liaising with the banks and talking to them about what we think should be, or suggestions for what we think could be done. Some suggestions have been interest waivers or interest holidays, future interest holidays, or other considerations that the banks can make, like if a customer is forced to sell their home as a result of COVID-19, whether the banks could consider waivers of the shortfall on their mortgage balance after the property is sold, if there is negative equity in the property. So these are things that these are potential solutions that we've been thinking about as a result of our casework, and that we're always liaising with the bank about at the moment. And so, yes, so just to summarize, that's a summary of the work that we're doing at the moment in relation to mortgage stress and COVID-19. Again, we service the entire western suburbs. We do have a particular focus on Wyndham at the moment, but we service the entire western suburbs. And if you do know of any clients or customers who are in mortgage stress and need assistance, definitely refer them through to West Justice and our Mortgage Wellbeing Service. Thank you.
Thank you very much, Matthew. You've got a really important job to do and a really big one that's only going to evolve, isn't it? And yeah, the worst is yet to come, I'd imagine. So we'll explore with some questions in the Q&A time, but now I'll hand over to Kelly Grigsby from Wyndham City Council, which includes postcodes 3029 and 3030, to give us some ideas of what council is doing in response.
Thanks so much, Bron, and certainly both Martin and Matthew have mentioned our suburbs. You know, they're coming up in those stats at the moment, and we know that often in the growth areas, things, you know, hang together by a thread sometimes for people living out in our areas. And, you know, it takes one thing to really upset the apple cart, and we're certainly seeing that play out in the city right now. I've got quite a detailed presentation that talks about some of the demographics really pertaining to Wyndham, and just sort of sharing some of those stories with you. I think in the interest of time, Bron, I'll probably just circulate that separately as part of the resource pack that comes out following the session. But I'll just highlight a couple of key things just so people have a bit of a context of Wyndham. Bron, as you said at the outset of today's webinar, Wyndham's actually one of the fastest growing cities across the country. We're also one of the youngest cities in the nation as well, and have one of the most significant sort of culturally diverse communities. We've got people coming from over 162 countries who sort of come here to make Wyndham home. Some obviously coming through skilled migration programs, others through the humanitarian refugee settlement program. So very culturally diverse city as well. As you've heard, prior to COVID, our sort of work was really focused very much on dealing with the essential sort of elements of economic justice, I guess. You know, when we think about the level of investment from government, the sorts of opportunities that need to really be created in the outer suburbs of the country, we were very much focused around becoming a polycentric city where we had, you know, that sort of economic investment to really create jobs within that sort of 20-minute city neighbourhood. So today's focus, of course, is really about the numbers. It's about the data. It's about what we can sort of see emerging now in response to COVID, but also what's to come. And as Martin said, you know, this could be sort of 3 to 4 years before we really see the penultimate impact of COVID, at least in a kind of social and economic context. So I think whilst we're talking about it, you know, in terms of economic data, I think we should also be looking at it in the context of how we can potentially transform some of our communities now to take advantage of some of the opportunities that COVID brings. And I think obviously we'll be having conversations in perhaps different webinars about what some of those opportunities might look like. But in terms of the impact of COVID right now on Wyndham and on the western suburbs and other growing areas across the country, we've really been concerned and scaling up service to really try and meet some of those new and emerging needs in response to COVID. And as Martin and Matthew have both touched on, we've been in the unenviable position of being one of the highest number of COVID infected municipalities. So that's something that, you know, we've really unfortunately seen, and there's a range of reasons for that. It's concerning on a range of levels, not only because of the immediate economic impact. So we've got people in our city who have obviously lost their jobs, who have been stood down as a result of COVID, but we're also seeing the proportion of residents within our city who have been in those insecure industries, who have been really, unfortunately, impacted by COVID in the workplace. So we're seeing a lot of that play out in the city as well. One of the other things that I wanted to highlight for the purpose of this discussion as well is just the ongoing primary health and perhaps acute health impacts of COVID-19 on community. And I guess that's sort of twofold. Firstly, in the context of recognising that this is actually more of a chronic disease or a chronic illness than first thought, in terms of, you know, it being like the flu. We know it's an extreme version of the flu, but in fact, there's some complexity about COVID-19 that we're starting now to understand that does have some ongoing health impacts certainly in particular people. So this is something we need to be thinking about as well, and there's obviously an economic cost to that, and also a level of vulnerability for communities like ours that have had those high infection rates. Thinking about the people who have been self-isolating, the people who have been in lockdown, not necessarily seeing their GP and following up on those things that they'd normally follow up on. So thinking about the broader health impacts of the COVID pandemic over time is critically important. So in terms of our council's response to COVID, certainly when COVID first hit in March, we were one of the first councils to start to provide service online, and we're very fortunate as a council to have had quite a bit of investment in technology to enable that transition to be quite seamless. Our focus was very much on us as a city leader and ensuring we were able to scale up really important service to community at the time when they needed it, including, of course, the business community, and also being a responsible workforce as well and ensuring the safety of our staff. So we introduced a range of responses to COVID-19, some of which included the scaling up of a website called Wyndham Together, where we curated a range of programs and activities from across the world to put into this website to sort of entertain and have people feel connected during that first sort of lockdown or sort of stage 3 restrictions earlier on in the pandemic. We also scaled up a community kitchen as well, because we knew that there were people in our communities, as Matthew has said, who had been hard hit immediately, who had worked in industries who were immediately impacted by losing their jobs or being stood down, some of whom have not yet returned to the workforce because their industry remains closed. So Community Kitchen was something really critically important for us, and we're still providing in the order of about 500 meals per week. So this really involved us repurposing essentially our events centre at Encore and the associated staff, as well as Tuck Shop, which people from Victoria are certainly aware of. We have our own cafe within the context of the civic centre itself. So these sorts of things were really key in terms of focus. But if I could just highlight a couple of key things. So the stage 4 restrictions have seen obviously a real shift again in terms of the scaling back of industry, the scaling back of people being able to operate small business. So council early on endorsed a Win Local support package, and it was really geared toward supporting local business. So we've essentially had a team of staff walking alongside business community at this time, really providing that sort of mentoring, coaching and day-to-day support to ensure they are able to pivot and provide service perhaps in a different way, to really make sure that they could kind of keep the light burning, if you like, during these difficult times. And we've continued to provide a range of services in that regard. But our city, as I mentioned, has been hit right across industry. So we've got a lot of industry that's focused around accommodation and food services, a lot of our industry in education and training, transport and warehousing, again, one of the higher risk industries, also significant jobs in construction and in retail trade as well. So it's hit economically, locally, really hard. So in terms of the more insecure workforce, council's been really committed to looking at how we provide, as I said, a much better access to local employment opportunities. And this is one leveraging point that I think growth cities have at this time, is to really leverage those opportunities that are coming out of COVID for people to be able to demonstrate their value and the sort of productivity elements of actually working remotely, in home as well, but perhaps looking at a bespoke model over time. So these are the sorts of things that we've started to talk about. Our council's had a really strong commitment for a number of years now around social and economic inclusion, and I think this work becomes fundamentally important over time, and really all of our kind of talent across levels of government should be focused on dealing with not only the fight against COVID in terms of minimising that infection now and into the future, but also starting to think about how we do build back better. And we're hearing that term used a lot at the moment, and in my mind, a a lot of that really does need to be on some of our more vulnerable members of our community, and some of the work that we've been doing at a sort of national and state and local level around social and economic inclusion, I think, becomes incredibly important. So these are some of the things that Council has been working on. I'd also add as well that we have been focused on how we actually work in partnership with government as well. So back in March, we actually scaled up a team who were going to support the health system. At the time in March, you know, in the first wave, we thought there'd be much more of a reliance on Council to provide that support. We didn't see that need, which was obviously a good thing, even though we'd sort of scaled up for that. We're now very much seeing that, however, in the second wave. So some of that work we did early on has certainly positioned our local response well in order for us to be able to support government. We've also scaled up some informal surveillance. We've provided an outreach program to those higher risk industries, and we're working closely with them, with our environmental health officers and also our economic development unit to ensure that they're complying, supporting government agencies in that work as well, but really making sure there's also that important, you know, connection from an economic development, business support perspective. So these are a lot of the things that we've been doing, and I'm happy to provide more detail on that as well. We are now moving into the contact tracing space, and we've been offering a team of people up now to DHHS for some time who are trained in that space. So we're now working with our local GPs across Wyndham to really help with that. And again, this is really about targeting those people who are most vulnerable, people who may not speak English, who are really socially isolated already, having trouble sort of interpreting the health messages. What does it mean for me in terms of if I'm testing positive for COVID, how long do I need to stay at home, what other supports are available? So these are the most sort of immediate response elements of COVID that we're working in at the moment. But as I said at the outset, we're also really looking at what's next in terms of recovery, but also how do we think about the future of work? How do we leverage the opportunities that COVID brings that aren't so much the negative consequences, but the ability for people to localise, for people to be able to work and live differently in the outer suburbs than what they ever have before, when you consider, you know, the vampire index and the number of people that we have commuting, of course, into key CBDs. So look, I think that's probably enough from me. I'm conscious that we want most of the time spent on Q&A, and as I said, I'm happy, Bron, to provide all of this information as part of the resource pack that goes out. So I might hand back to you at this point. Right. Thanks, Bron. Thank you.
Thanks very much, Kelly. And, you know, what an enormous range of activities and responses Wyndham has come up with. And, you know, like all of our member councils, just a complete shift in service delivery models and newly vulnerable communities. So I might just jump to some questions, but there's a few other things I'd like to pick up with each speaker along the way. But our first question is from the chair of the National Growth Areas Alliance, actually, Councillor Matthew Deeth from Wallandilly Shire Council in southwest Sydney. And he's just asked about, you know, given the challenges with mortgage and rental stress across the nation in growth areas, what are the policy levers you can suggest that we, as the Alliance and local government, should be advocating to alleviate the issue, both short and long term? So, Martin, I might throw to you for the first response on that one.
Right. Well, I think the first thing we need to do is to raise greater awareness of the concept of mortgage stress or financial stress, right? What I find in my surveys is that the first response when people get into financial difficulty is to hope it'll go away, put their head in the ground and say, she'll be right. That's a very Australian thing to do. The truth is that in the current environment with, you know, record low wage growth, probably going negative, very high unemployment, we're going to find more and more people getting into more and more difficulty. And many people have no idea, one, that they're in stress to start with, right? And in fact, I ask that subjective question before we then actually go through and get the information. And basically there's a mismatch. So there has to be an education awareness lever more than anything else, I think. And I'm not sure that you can leave that to the banks to have that conversation with end customers of the bank, because the banks are always in it for themselves. They're always in it to safeguard their own risk profiles and their own books. So we need to find a way to be able to get that out into the community. I think that's the first point. The second point is we've got to the point in Australia where the debt is unsustainable because it's not equally spread across all households. We've only got 1/3 of borrowing households amongst all households. And for many of them, they've got so much debt that they're going to be struggling with it for generations, frankly. So we need to think of a different policy response just to continue to say, take some more debt, which of course is what the Reserve Bank and what the regulators are actually doing at the moment. And by the way, what the bank is doing, and Matthew made the point, it's ticking up. If you're not paying your mortgage back, it's ticking up. We need a different policy response from our regulators and from the government with regards to how you deal with this too high debt and stop giving more of the same drug when it's the drug that's killing the patient, right? So that's the second point. The third one is there's a very important conversation here about the relationship between rental stress and property investment and mortgage stress and property investment, because everybody's up to this point believed that property is somehow this magic thing that always goes on giving. And in fact, in my surveys, half of the population still believe that property values double every 7 years. We have to get people to understand the reality of owning property or renting property. So I think there's a communication issue here, and you can't leave it to the construction sector who just want to flog more properties, or the real estate sector who just want to do more transactions. There's a missing piece of the puzzle in terms of helping people to understand the reality of renting or owning. So I think these are education issues. I think these are policy levers that central government and indeed, maybe even a local government can get involved in. But ultimately, it's got to be about, firstly, greater awareness, and that's where DFA is trying to help.
Great, thank you. Matthew, you spoke a little bit about some of the things that you're advocating for change, and not just from the banking sector, but from a legal perspective. What are some of the other things that you think we should be calling for change?
So what I will say is that I think mortgages, in the very way that they are structured, seem to me to be based on a bit of a hangover of the past, where they are structured to suit maybe what the familial structure used to look like, say 50, 40 years ago, maybe where you had husband working in the same job for 40 years, wife working at home, taking care of the home. That's not necessarily the case these days. Times change and familial structures change and society changes. And I think mortgages and the banking industry needs to evolve with those changes. And we're probably not seeing that evolution happen quick enough. I think that just a suggestion could be break periods being written into mortgage contracts. At the moment, the structure of a mortgage contract typically is that it runs for 30 years. You have to maintain your payments and not miss a payment throughout that 30-year period, which is based on an assumption that a person is going to be in a situation where they can maintain the same payments for a 30-year period without their situation changing. And I think to suggest that most customers are going to be in that fortunate situation would be very foolish. So I think the industry and the way mortgages operate needs to become a bit more flexible, needs to be a bit more creative, and they need to start thinking about different ways of offering services and products like mortgages to take into account these sort of vulnerabilities like family violence and mental health issues, COVID-19 now, that impact on your ability to meet your repayments. And yeah, like I said, I think something like a break period in mortgage repayments where you can actually opt to have a period of no payments for a certain period and not fall into arrears for that period is a suggestion that might be suitable.
Good, yeah, thank you. And Kelly, I know you've spoken a little bit about how we sort of come at this issue from the other perspective, which is not just the immediate crisis around paying the mortgage or paying the rent, but how do we actually get people back to work? And I think some of the recent research that NGAA did on working from home showed that, you know, there's 500,000 people in growth areas who do sort of work that could be done from home. So how do we, you know, how do we convince governments and the private sector to make that happen, to reduce household expenditure on transport, for example, to, you know, on their long commutes into town? So, so Kelly, is there anything more there that you'd like to say about, you know, what those levers are from state or federal government that we need to convince them to change?
Look, I think, Bron, it really does get down to sort of investment in the sort of polycentric city model and using this as a sort of burning platform really to sort of, you know, I guess leverage those conversations. But I think fundamentally it's actually about engaging now with companies and the private sector to really encourage them to use the future of work model and think about, you know, how they can support workers to work from home in an ongoing way. Now that this has been, you know, a significant experiment, what are those opportunities to continue that forward? Because that will really help, I think, to continue to build local economies. There's obviously going to be huge contested space here, though. You look at, you know, the push now within the capital cities to get people back into city centres, to get business up and running in the CBD. And of course, that's important, but we need to make sure that that doesn't go back to what it was at the expense of the outer areas and trying to create that enhanced livability. But fundamentally, of course, it does come down to people being able to live day to day and dealing with that mortgage stress issue. How we can provide material support more immediately is obviously fundamentally important. But I think having some of those policy discussions now are critical, but we shouldn't just wait for government. We need to take, I think, as councils leading these large areas into the future, we need to be taking it upon ourselves to be driving some of the industry thinking around this as well. Thanks, Bron.
Yeah, good. Actually, Kelly, I might keep you on because I've just got a quick question here, which I'll throw to you, but then I want to follow up with Martin. So are you aware of any discussions going on with government to continue and extend housing people in hotels or student accommodation for that sort of crisis accommodation?
Look, not officially. I know that there have been some discussions informally going on, and particularly in the context in our municipality, for instance, where we've got large family cohorts living in quite small dwellings. So even the ability to sort of self-isolate, you know, if tested positive for COVID and so on and so forth. So trying to provide that very basic level of support so that people can be accommodated away from family members, for instance. So I do think that there are some discussions underway there. As to how far they've progressed, I'm not sure. That's certainly something we're keeping in close contact with DHHS and obviously Department of Housing on. But I think it's a really important question and something that we'll need to have some answers to pretty quickly.
Yeah, thank you. I wanted to follow up then with Martin because I've heard, you know, through a couple of conversations we've had and some of your podcasts and webinars that, you know, quite often it's not a quick overnight change from being in mortgage stress to being without a home to live in, and it can take some time. And there's some, I also wanted to just tie that into, you know, what you were talking about recently in unemployment numbers and, you know, real unemployment and underemployment numbers. So I suppose it is just putting these things together to really reiterate that this is just the start, you know. So your thoughts on what we can expect to see coming up?
Yeah, I mean, it is a very important point. The official statistics with regard to unemployment are actually understating the real situation for all sorts of reasons, right? The true rate of under and unemployment together probably means about 1 in 5 households are now facing no income unless they get government support in some way. That's huge. That's a huge change from where we were. And if you look at all the studies around the world, you always go down the escalator when unemployment rises, but you have to climb the stairs to get back out of it again. And that can take 3 to 5 years. And in fact, the Reserve Bank is now saying the official number will probably be 10% unemployed by the end of this year and 7% 2 years later, right? So these are huge structural issues. And I'd also make the point that whilst originally a lot of the unemployment was from casuals and part-time and, you know, bitty jobs, we're now seeing what I call structural unemployment. So we're suddenly seeing mainstream jobs disappearing from the finance sector, from consulting, and therefore this is a much broader issue than many people think. And I actually think the government is not doing anybody any favors by trying to talk it down and say, well, it's all about jobs, right? There's a much more fundamental issue here about how do we value people, right? If we only value people when they're working, then I think we have a philosophical issue about what is the value of people. That's the first point. The second point is that the support mechanisms that need to be in place to handle such large volumes of underemployment and unemployment is going to create a huge logistical issue, not just for the next few months, but this is a 3 to 5 year thing, right? And then going back to your earlier point, mortgage stress takes a long time to season. So people will struggle on. They will continue to try and make payments. They'll get into difficulty. They'll refinance. They'll put more on credit cards. It can take 2 or 3 years for the pressures to build and build and build. And then something goes, you know, bang, and they've got to do something. Now, there is no appetite within the finance sector for early watching what's going on, an early reaction and being proactive on this, right? They just wait for the problem to have hit. So that's a problem. The second problem is the way a mortgage works is that the borrower takes all the risk effectively, because if they put 20% of equity in, basically they can lose 20% of the equity and they've lost everything and the bank is still fine. I think, going back to Matthew's point, there's got to be a different way of thinking about shared risk, both upside and downside. That would actually put a much stronger discipline on the banks with regard to how they lend and how they think about lending, and that could actually be really beneficial. And then the final point is we have to be understanding that there is a whole cadre of people in their mid-50s and above, right, who still have mortgages and will have mortgages into retirement, who may never get a job again. And I'm very concerned about those particular cohorts because, again, I don't see the programs in place to address that critical element where we have a number of older people who are very capable people, very willing to work, but cannot get back into the workforce. And if you look at all the studies around the world, it's that group that ultimately get pushed out and often end up moving into retirement, not in owning a property, but in rented accommodation without any income, and then have huge problems into old age. That is probably one of the most critical social issues that I'm concerned about at the moment.
Gee, yeah, that's another element. There's another perspective as well. And Matthew, just a quick question then. I mean, have you seen, you know, a enormous increase in your caseload, and are there different demographics emerging? Like as Martin was just saying, are there some of those older people in mortgage stress who really don't have much prospects for future employment?
Yeah, the thing is, the numbers in our casework are actually very low at the moment, typically much lower than before. And the reason for that is because of the bank's temporary assistance right now in regard to moratoriums. We're going to have a much clearer idea of what the demographics look like and what the impact will be after the moratorium assistance ends and when everyone is left in the lurch. That's when the customers of banks will be coming to us asking for help. But at the moment, it's actually not high numbers at all. Sorry to say. I can't give too much insight there because, yeah, we have not got it yet.
It's all to come, I suppose, isn't it?
Yeah.
Matthew, I was just going to say, sorry, Bron, just from a local government perspective, we're certainly seeing the immediate support that people are requiring, but that's certainly mirrored what Matthew's saying is mirrored in our request for hardship as it relates to rate relief, for instance. We've had only really a small uptake in requests at this time, so it'll be interesting to sort of see how that does trend along similar lines as well.
Yeah. Kelly, one of the things that we know the federal government and state governments have been doing is lots of stimulus packages around construction and particularly residential construction industry. What are your thoughts around, and we're getting close to the end of our time, but what are your thoughts around this push to fast track new development, new estates, are we risking, a question here, are we risking new estates laying idle? What does that mean for civic pride and community safety?
Yeah, look, it's a really good question, and one that I think we need to be occupying actively our minds with as I talk about sort of leveraging some of those other things that come with, a sort of a return to a post kind of COVID world. There's no doubt that there's a huge reliance on stamp duty and, the development industry to kind of sustain, because you look at the workforce that are engaged in these construction industries, they directly benefit our cities, because a lot of these people who are working in construction are our residents. So, it's not as simple as just turning off the tap, which is why I think it's incredibly important to have the sort of fast tracking to kind of keep that momentum going and that sort of cash flow, for the want of a better term, for government at this time and the people employed in those important jobs. But yeah, absolutely. I mean, we see that people are investing in some of these properties, they may not live in them. So with the change in, the sort of the property market, that could lead to these sorts of issues that the question proposes. And I think as councils, we need to be really closely monitoring this situation and working with the likes of the VPA in Victoria and, the equivalent agencies, certainly in New South Wales, to really manage this. So I don't have a precise question, but I think it's something that will certainly be occupying our minds and needs to. It's a really good question.
And, I think that's, something that we've certainly supported is to, so many people in growth areas do work in construction. It's important to keep it going. But Martin, does that mean, are we just deepening that dependence on property investment and development in our economy?
Well, that's the problem. We've actually had a policy failure over 30 years, I think, to be honest. And the idea of bribing first-time buyers to go and buy home and land packages and give them $55,000, and by the way, home and land packages go up by $55,000, so it's a net sum game, when in fact the whole economy is a bit suspect, I think is concerning. There's 1.2 million spare properties across Australia, 1.2 million. We do not have an undersupply of property, right? So whatever the construction sector says about we need to build more, that's rubbish. We actually need to build better, higher quality, and in the right place at the right time, not just build up thousands and thousands of cheaply constructed, printed properties. In my view, there is a very important question about home ownership, and people want to own property. I understand that. But I think we need to find a different narrative from the one that's being preached by central government at the moment. I'm afraid that this whole bribe process is more about fixing the construction sector rather than helping people really to get into good, affordable housing.
Yeah, you certainly got a good point there. And, I think, again, it's one of those things where we are still a long way away from seeing the real impact of all of this. So as Matthew prepares to gear up, I'm sure that caseload is going to increase fairly soon, and Kelly the same at Wyndham. When the moratoriums do finish and when Job Seeker does finish, I mean, we've got another 6-month extension on a lower rate, but that's such a useful thing to keep people just with their heads above water. But what happens when that finishes is going to be quite an enormous shift.
I completely concur with Martin's view on this. I think it is a huge policy problem that we have. And I think the struggle we have in the outer suburbs in these growth areas is how to enhance livability with what's already happened. And certainly that focus around activity centre nodes, the focus around mixed use, the focus around that sort of polycentric city concept needs to help really drive that response. So working with developers on doing better, as Martin said, is absolutely what we should be focusing on for sure.
Fantastic, thank you. Well, our time is up, so a really enormous thank you to Martin, Matthew and Kelly for your time and input today. This is such an important issue for us going forward, and I think as we develop on behalf of our member councils, as we look at what our policy platform is going to be for the next 12-18 months, it's really going to be quite different to what it was even just 6 or 8 months ago. So, this is a real shift in so many in so many ways. But thank you very much. We will place the recording of this and some other resources on the event page on our website later today. And while you're there, maybe have a look at some of the other webinars coming up. In a fortnight, we'll be taking a deep dive into youth mental health in growth areas. For, I would say, every single one of our members, it's one of their top challenges. And we'll be looking at Camden Council in Sydney's West and how they've approached securing a headspace presence in their municipality for their incredibly young and incredibly fast growing population. So thank you all very much, and we will see you on this recording on our website later on today. But thanks again.
Thanks. Goodbye.
Thank you, Bronwyn.